And I think that's what I most learned at Blackstone. So I'll talk a little bit about that experience. So I had a phenomenal experience at Blackstone. I would say, day one I showed up, and unlike every other person that they hired, I had never worked with EBITDA before, like ever. I'd never seen an EBITDA business. And the first model that I was assigned was, of course, an EBITDA model. And like, I didn't know what stock-based compensation, I didn't know what any of this was, right? And so it's like, I spent my first 3 days kind of frantically figuring that out. The nice thing about coming from FIG is you learn a lot of really technical stuff, and you learn a lot about structuring, but you're not going to learn. Once you've done FIG, like everything else seems easy by comparison. So that was nice, but it was a little bit of a shock to the system when I first got to Blackstone. I would say like initially when you're there, you're operating more like an analyst than you are. Your title's associate, but they want to make sure that you can do the bare bones of the job when you first show up. And so I spent most of my first 6 months kind of, probably 3 months, like building models, right? They want to see that like your knowledge of that and your ability to check the detail and like stay on top of that stuff. They want to kind of make sure that that's solid, which makes sense, right? Because you want to make sure you have the foundation before you then progress. But the nice thing is they're kind of willing to give you all the responsibility that you can handle. And so my first real deal was actually a pretty lean team. So like Blackstone, and you'll see this with the Megafunds, they tend to have larger deal teams, right? So that's going to be 5 to 6 people, whereas I think historically deal team size, when you think about it, you think like 3 to 4. And so my first deal at Blackstone was actually 3-ish people, so much on the much leaner side of things. And so I got to do a lot of really cool stuff. I got to, manage the bankers in that process. I got to manage the consultants in that process. I got to run the model. I got to interact on a regular basis with the management team. Like all the things that are the hallmarks of the fun parts of the job, I kind of got to introduce and layer on in addition to the technical analysis. I got to be in charge of like the tax implications of the deal and all that stuff. And so my day became a lot more extroverted on margin. So I was spending 50 to 60% of my time talking to people, which for me, like that's what I love those interactions. I love those debates. And so that was actually a great exposure for me. The people at just in general about Blackstone, like the people are among the smartest you'll ever meet, which is incredible. And like, they're just it's a very intense place to work, which is awesome. Like people eat, sleep, and breathe the job. They love what they do. They're super passionate about it. And I mean, look, Blackstone is an extremely rigorous place to work, like in terms of the excellence that's demanded and the standard that's been set for, 30 years. Over the summer, I actually, of my MBA, I spent time at a much smaller firm that had been founded in 2011. And it's so interesting. I'd never really thought about this before, but like a place that's been around for 40 years, right, is going to have a very different culture than a place that's been around for, 8 years, right? And precedent is going to play such a bigger role at a place where everything has systems and processes. It's a large institution. Like the people at the top are more risk off and they're looking for leverage from the people beneath them. It's just a very different feel than a place that's a little bit more entrepreneurial, neither good nor bad, but just something again to consider when looking at different organizations that you may want to go work at. And so that was super interesting for me to see. I would also say a mega fund is going to take a very different approach to investing than a fund that has fewer assets under management. So when you think about a mega fund, right, Blackstone's latest fund is $26 billion. The average private equity, like equity check size is, $250 million. And so even if they do all $500 million equity checks, that's still 50 portfolio companies that they're going to have in this one fund. And if you just think about like the, people economies of scale, like that's not a lot of time for individual investment professionals to spend on each portfolio company. So the type of investing looks a little bit more like levered S&P and a little bit more like a private hedge fund than it looks like, an operational approach to private equity, just simply because of the time. Now that said, like Blackstone obviously has a portfolio ops team and all those things, but if you just think about your life as an investment professional, you're spending more time on deal sourcing, deal pursuit, right? So a deal analysis, and less time on average, I think, relative to other private equity firms on portfolio ops. So just, again, things to consider when looking at different sizes of firms and the way that these firms sort of do the business.